Hello and welcome to this special broadcast on Bloomberg Quint. Joining us on the sidelines of the Morgan Stanley Investor Conference is Anil Agarwal. He is the head of Asian Financial Research, ex-Japan at Morgan Stanley. Of course, he closely tracks the Indian banking stocks as well. Anil, thank you so much for joining in. Let me ask you, given the fact that the current banking space is plagued with asset quality issues, what is the house view at Morgan Stanley with regards to the asset quality and the entire banking space?
No, so we like Indian banks, not across the board, but we like Indian banks because I think the retail lenders in India are strong compounders. We think the growth optionality in those banks or NBFCs continues to remain very high. I'll talk about that. On the corporate lenders, whether it's private or state-owned, we have obviously been seeing asset quality issues for multiple years. Last year, the NPL formation increased dramatically, but actually if you look at the flow of new bad loans, which is loans which were called by some other name till last year, whether it was restructured, whether it was S4A, SDR, 525, watch list, drill down list, every bank has its own classification. That number has generally, by and large, not been going up. That number is more or less static. What has essentially been happening is that the total bad loan book is relatively stable now. But within the bad loan book, you are seeing better recognition. So banks are actually calling things NPLs because of RBI's push. So what we are seeing right now is that our view is that as you go into fiscal 19 or as the banks start reporting, the total bad loans are unlikely to go up. NPLs will keep creeping up. But what will happen and will hurt earnings for this year will be a provisioning catch-up. Because if you look at the banking sector as a whole, the total loan loss provisions on all the bad loans combined is about 45%. For some of the bigger banks, it's only about 40%. Our view is that the coverage ratio needs to be 60%, which means that you have one more year of bad earnings. But as you go into fiscal 20, so 1st April 2019 onwards, our view would be that provisioning catch-up would be done. New bad loan formation will slow down dramatically, and hence these stocks should do well then. So what we like are retail banks, and we like the private corporate lenders.
Okay, so would your stance continue to be remaining underweight on PSU banks and slightly overweight, or the preference really would be towards the private banking stocks?
Yeah, absolutely. Because PSUs, the thing with PSUs is that their underlying profitability is very weak. So when they're taking the provisions can either be taken through your pre-provision profits, so you don't make a loss, or it has to be, or the rest will come through losses and hence capital. For the state-owned banks, with the exception of the largest bank, generally, or the two of the largest banks, generally the pre-provision profitability is fairly low, as a result of which they'll still need to raise capital. So our view is that the incremental capital needs for the state-owned banks to reach the minimum capital ratio requirements is about 1.1 to 1.2 trillion rupees, of which the government has said they will give about 650 billion rupees. So the rest will have to come from the markets or through stake sell downs. What that does is that will solve the capital issue, the NPL issues hopefully at these banks, but after that you won't have any growth capital. So we are assuming that there will be no growth in these state-owned banks with the exception of the two large banks, and even then you end up with a 1.1 to 1.2 trillion rupees of capital requirement. So for them to grow, I think it's going to be very tough. Yeah, those stocks are cheap, there will be trading rallies, but apart from the couple of large guys, I think we generally would not look at owning them. We prefer the private banks because private banks offer you meaningful compounding. Like even the largest banks or some of the largest banks will grow at 15, 20, 25% for the next few years because state-owned banks' market share is there for the taking for these banks.
Anil, also explain us about the valuation bit because the stock prices, especially in the PSU universe, have corrected significantly. Even the private banks have not generated significant returns despite the catch-up on earnings or probably the asset quality problems behind us. So at the current market price, do you expect that the valuations are reflective of the problems and probably investors can now start approaching these stocks?
No, so the larger private corporate lenders we like, and the reason is, as you said, our view is that it's they're pricing in a lot of problems, and obviously the problems are there. There is a lot of provisioning still to be taken. There are NPLs yet to come. There is capital required in a couple of cases. But as we move forward over the next 4 quarters, I think what you will see with these large corporate lenders, the largest ones, the 3 largest ones, is that you will see the underlying earnings pick up. We expect some margin expansion over the next 2 to 3 quarters in these banks. And over the next 4 quarters, I think the provisions will be taken. And those stocks are cheap, especially, a couple of them are trading at about book or less than book right now. Obviously, there's a lot of news flow around these names from all sorts of perspectives, and that is reflected in the valuations. But if you can take a 4 quarters view, these stocks will be very, very volatile. But if you can take a 1-year view, I think the upside here can be reasonably material.
Okay, got that. Anil, I was also reading your blue paper on the digital banking bit, and how this will really change the face of banking in India. If you could give us the key points or highlights of your report, and what is your thesis, and how will this really impact the entire banking space?
No, so our view is that UPI is just an exceptionally good innovation. I mean, if you look at the UPI trends in the last 6 quarters that they have been in existence for, the total volumes or total value of transactions which is flowing through UPI now is almost 2% of GDP annualized. If you look at April data, that within 6 quarters of launch is exceptional. I mean, till 3 years back, the total digital payments in India was 2.5% of GDP. So our view is that UPI over the next 5 years should be about 10% of GDP, which means it will grow at about 90% CAGR. And what it does to the banking sector is that, see, banks do not, or nobody makes money on domestic payments. I mean, domestic payments is not really a revenue line. It's more about customer service, customer retention product. Our view is what UPI will allow banks to do is, over time, it will allow banks to deliver financial products, banks or anybody else in the ecosystem, to deliver financial products very, 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 very cheaply, whether it's sale of mutual fund, whether it's sale of life insurance, whether it's a new loan, more importantly, collection of new loans. So even the smallest value loan will become one of the problems with a small value loan, whether it's a microfinance loan or whether it's a small value personal loan. One of the biggest costs for these banks or NBFCs is the operating expenses, because these are small value loans. But if these can be disbursed or recollected, the repayments can be done through UPI. I mean, even they can potentially, theoretically, do a 100 rupee transaction on that, and with almost no incremental cost. So our view is that what you will see is that the cost of credit delivery and repayments and cost of financial services delivery will just collapse in India. And that is going to be very, very, very good for the sector as a whole. So you will see lower yields. Banks will be able to cut down the spreads that they're charging on various loans over time, because they will be able to bring down their operating expenses a lot. And the winners would be the guys who basically get a large market share in the UPI. So some of the weaker banks, I think, will just fall by will lose a lot of share, and the bigger banks will gain a lot of share because of this.
Okay, Anil. And one final question from my side, on the digital banking space, most of the bankings, if you look at the entire sector, has been speeding up the process, for digital transaction, promoting digital transactions. Probably a few banks like SBI have opened digital branches. So now with the speed up that we are looking at in the process of digital banking, do you think the market share gains will be for larger players, especially the private players, and probably PSUs who do not cope up with the digital story would tend to lose market share?
Yeah, that would be my thesis, because what's been happening is that the market share gain in loans has been quite rapid. So if you look at last 3 years, the loan market share shift away from state-owned banks to the private banks and NBFCs has been at the rate of 400 basis points a year. Like in the last 3 years, state-owned banks have lost 12 percentage point of market share in lending. Before that, they used to lose market share at 1% a year. But on the deposit side, the market share loss has been much, much, much slower. What digitization across various parts of businesses would do is that it will essentially, in our view, over the next 2 to 3 to 4 years, you'll see the smaller banks will lose deposit market share more and more quickly, which will ultimately flow through to the private players. So the market share move, both on the assets and the liability side, I think will be hastened or quickened because of the digitization of, again, financial services in India.
Okay, thank you, Anil, for taking out the time and speaking to Bloomberg Quint. So that's all we have, and this is the special coverage for Morgan Stanley. For more, do watch our website bloombergquint.com for more updates.